Imagine waking up one day, your entire life savings, your home, your future gone. Not because of a personal mistake, but because of a massive financial collapse that started thousands of miles away, fueled by a single idea: the American dream for sale. In just 2 years, over 2.3 million families lost their homes to foreclosure in the U.S. alone, wiping out $8 trillion from stock owners' pockets and threatening to bring the entire global economy to its knees. For decades, owning a home was the ultimate symbol of success in America, a stable investment, a foundation for family. But by the early 2000s, this dream was being aggressively repackaged and sold, not just to those who could afford it, but to anyone with a pulse and a signature. This insatiable hunger for homeownership, fueled by reckless lending, inflated a monstrous housing bubble across the United States. And when that bubble burst, it didn't just pop in America. It sent shockwaves across oceans, triggering the 2008 global financial crisis, a cataclysmic event known as the Great Recession. It started subtly in the mid-1990s. Banks began loosening their lending standards, eager to get more people into homes. Regulations shifted, encouraging wider home ownership. By the early 2000s, the floodgates opened. Mortgage lenders like Countrywide Financial and New Century Financial started offering what seemed like a golden ticket: subprime mortgages. These were high-risk loans, given to borrowers with poor credit histories, limited income, or high debt, people who traditionally wouldn't qualify for a home loan. Lenders reduced documentation requirements, lowered credit standards, making it easier than ever to get a mortgage. The result? Housing demand exploded, and home prices soared. Between 1997 and 2006, U.S. housing prices rocketed by an astonishing 124%. Many of these subprime loans came with seductive but dangerous features: adjustable interest rates, known as ARMs, that started with a low teaser rate, or even balloon payments that would suddenly spike after a few years. It was like offering someone a tiny monthly payment for a luxury car, without telling them that in 2 years, the payment would quadruple. People were buying homes they couldn't truly afford, gambling on ever-increasing property values to refinance or sell before their payments exploded. And Wall Street was watching, ready to make a fortune from this gamble. This is where the financial wizardry, and ultimately the disaster, truly began. Investment banks like Lehman Brothers and Bear Stearns saw an opportunity. They didn't just want to sell mortgages, they wanted to package them up and sell them to investors worldwide. This process was called securitization. Think of it like this. Imagine a farmer with a huge basket of apples. Some are perfectly ripe, some are a bit bruised, and some are downright rotten. Instead of selling them individually, he bundles thousands of these apples together, squishes them into a pulp, and pours the mixture into different jars. These jars are then labeled mortgage-backed securities, or MBS. Investors, from pension funds to international banks, bought these MBS, believing they were getting a safe, diversified investment. But it got even more complicated. These MBS, some filled with those rotten apples of subprime mortgages, were then bundled again into even more complex concoctions called collateralized debt obligations, or CDOs. Imagine taking those jars of apple pulp, mixing them with other fruit pulps, and then pouring that mixture into even fancier, layered containers, sliced into different tranches, some supposedly safer, some riskier. The illusion of safety was maintained by credit rating agencies, companies like Standard & Poor's and Moody's. They were paid by the very banks creating these products, and they assigned high, often misleading, credit ratings to even the riskiest MBS and CDOs. It was like the farmer paying an inspector to label his rotten apple pulp as prime organic produce. And then came the ultimate gamble: credit default swaps, or CDS. These were essentially insurance policies on these toxic assets. Companies like American International Group, or AIG, sold CDS, promising to pay investors if the underlying mortgages defaulted. It was like betting on your neighbor's house burning down, but without having the money to pay out if it actually did. The system was now a house of cards, built on debt, deception, and a fundamental misunderstanding of risk. For a while, the music played on. Everyone was making money, or so they thought. But beneath the surface, the cracks were appearing. By 2006, the housing bubble reached its peak. Home prices, which had soared for a decade, stopped climbing. Then they started to fall. In the same year, mortgage loan delinquency began to rise, and a staggering one-third of all mortgages were now subprime or no documentation loans. Loans where borrowers didn't even have to prove their income. The first wave of pain hit in early 2007, as those low teaser rates on subprime mortgages reset, causing monthly payments to skyrocket for millions. Homeowners, unable to afford their suddenly massive payments, began defaulting en masse. Lenders like New Century Financial, once giants of the subprime market, filed for bankruptcy in April 2007. The initial foreclosure filings, which stood at 717,522 in 2006, were just the beginning. By August 2007, the contagion spread. Financial institutions across the globe, holding billions in these supposedly safe MBS and CDOs, realized their investments were toxic. French bank BNP Paribas froze 3 of its funds, citing a complete evaporation of liquidity. Central banks frantically began injecting cash into the system, a desperate attempt to keep the global credit markets from seizing up. The U.S. Federal Reserve began cutting interest rates, a signal of grave concern. The world was waking up to a nightmare. The year 2008 dawned with a chilling reality. The global stock markets tumbled, gripped by fears of massive U.S. subprime losses. The Federal Reserve made its largest emergency interest rate cut in 25 years in January, a clear sign of panic. In March, the venerable investment bank Bear Stearns, once a Wall Street titan, faced bankruptcy and was hastily sold to J.P. Morgan Chase in a government-backed deal. But this was just a prelude. By July, concerns mounted over Fannie Mae and Freddie Mac, the 2 government-sponsored enterprises that bought vast numbers of mortgages, including many riskier ones, and bundled them into MBS. Their share prices plummeted. On September 6th, the government was forced to step in, placing Fannie Mae and Freddie Mac into conservatorship, taking over their staggering $5.2 trillion in debt. Then came the financial earthquake that shook the world. September 15th, 2008. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy, the largest in U.S. history, with $619 billion in debts. On the very same day, Merrill Lynch, another Wall Street giant, was acquired by Bank of America in a desperate rescue. The next day, September 16th, the U.S. government was forced to bail out AIG, the massive insurer, with an initial $85 billion package, which eventually grew to a staggering $182 billion. The dominoes were falling, and the entire global financial system teetered on the brink. The consequences were immediate and brutal. For millions of ordinary homeowners, especially those trapped in subprime mortgages, the dream became a nightmare. As interest rates reset and home values plummeted by over 20% from their peak, their equity was wiped out. Foreclosure filings surged from 717,522 in 2006 to a staggering 2,330,483 in 2008, affecting 1.8% of all U.S. homes. Families lost their homes, their savings, and their futures. But the pain wasn't confined to homeowners. Investors, from individual retirement savers to massive pension funds, lost trillions as the value of MBS and CDOs evaporated. U.S. stock owners alone suffered about $8 trillion in losses between January and October 2008. Banks globally faced over $1 trillion in losses between 2007 and 2009. The crisis triggered the Great Recession, throwing millions out of work and bankrupting countless businesses. The Dow Jones Industrial Average plunged to its Great Recession low of 6,547 points by March 2009. Taxpayers, who had no part in creating this mess, were forced to bear the burden of bailouts for too-big-to-fail institutions. The government had to pump billions into the system to prevent a complete collapse, funds that ultimately came from ordinary citizens. The American dream, once a symbol of opportunity, had become a cautionary tale of unchecked greed and systemic risk. The 2008 financial crisis was a stark reminder of how interconnected our world truly is, and how easily financial innovation can morph into predatory exploitation when left unchecked. It reshaped millions of lives, shattered trust, and forever changed the way we view financial markets. The lessons learned were painful, that a gamble in one corner of the world, A subprime mortgage in a quiet American suburb could trigger a global catastrophe. While the Great Recession officially ended in June 2009, its scars remain, from lingering economic inequality to a deep-seated skepticism about the financial system. We saw the true cost of chasing an illusion, of selling a dream without a solid foundation. The question, then, is not if such a collapse could happen again, but whether we've truly learned enough to prevent it. Or are the seeds of the next crisis already being sown, hidden in plain sight, waiting for their moment to burst?